The three safest types of investments in the U.S. for 2026. When beginners hear the word safe, they often think it means no risk. That's not how investing works. In reality, safe investing means controlled risk, predictability, and resilience across economic cycles, especially looking ahead to 2026. This video is not about maximizing returns. It's about protecting capital while allowing steady growth. 1. High-quality government-backed assets. The first category is the foundation of safety in the U.S. financial system: government-backed instruments. This includes Treasury bills, Treasury notes, Treasury bonds, Treasury-based funds. These assets are considered among the safest in the world, not because they grow fast, but because default risk is extremely low. For beginners, these investments serve a clear role. They preserve capital, they provide stability, they offer predictable income. Returns fluctuate with interest rates, but the structure remains reliable. These assets are not designed to build wealth quickly. They are designed to anchor a portfolio. 2. Broad market index funds. The second category surprises many beginners. Stocks can be safe when used correctly. Broad market index funds invest across hundreds or thousands of companies. Examples include total market funds or large-cap index funds. Instead of betting on individual companies, you participate in the overall economy. This spreads risk widely. Historically, over long periods, these funds have delivered consistent growth. Not every year is positive, but time smooths volatility. For 2026 and beyond, broad index funds remain one of the safest ways to grow wealth gradually, not because markets never fall, but because diversified systems tend to recover. Safety here comes from diversification, not stability. 3. Conservative, income-focused real estate exposure. The third category is real estate, but not aggressive speculation. Conservative, income-oriented exposure. This can include well-located rental properties with modest leverage. Real estate investment trusts focused on income. Diversified real estate funds. The goal is not rapid appreciation. The goal is steady cash flow and inflation protection. Real estate behaves differently from stocks and cash. That difference adds balance. In uncertain environments, income-producing real estate often holds value better than expected, especially when debt is controlled. For beginners, safety in real estate comes from patience and simplicity, not from leverage or speed. What these three have in common: they are not exciting, they are not fast, they are not trending on social media. And that is exactly why they are safe. Each one plays a different role. Government assets stabilize. Index funds grow. Real estate provides income and resilience. None of them need perfect timing. None of them rely on predictions. The beginner takeaway: safety is not about avoiding movement. It is about choosing structures that survive movement. For 2026, the safest path for beginners is not a single investment. It is a balanced combination. Closing thought: safe investing isn't about doing nothing. It's about choosing things that still work when conditions change.